Major funding for these programs is made possible by grants from Chase Commercial Term Lending, New York Community Bank, Capital One Bank, Perfect Building Maintenance, M&T Bank, Customers Bank, Genova Burns, Terra CRG, Meridian Capital Group, Wyckoff Organization. Additional support is made possible by AKA Hotels Corman Communities, Aerial Property Advisors, AVR Realty Company, Bank of America Merrill Lynch, Bank Leumi USA, Briarwood Organization, CBRE, Citizens Bank, Colliers International NYC, Collins Building Services, CPEX Real Estate Services, Cushman and Wakefield, Dime Savings Bank of Williamsburg, Douglaston Development, Levine Builders, Eastern Union Funding, Fisher Brothers, First Nationwide Title Agency, Flushing Bank, Friedman, Handler Real Estate Organization, HAP Investments, Hersha Hospitality, Hodges Ward Elliott, Inc., Investors Bank, James D. Kuhn Real Estate Center at Syracuse University, Kilroy Architectural Windows, Madison Realty Capital, Matone Group, Mercantile Commerce Bank, New Banks, Newmark Grubb Knight Frank, Optimum Window Manufacturing Corp., People's United Bank, Rosewood Realty Group, SJP Properties, Sterling National Bank, Stonehenge Partners, TD Bank, The Continuum Company, The Moynihan Group, and these friends.
Everybody wants to come to New York. Money is flowing from China, from Japan, from Norway, from Israel, from every country around the world. So why do they want to invest in New York, and who is investing in New York? So today my guests will provide their insight on that, Mark. My guests include Eran Polack, who is the co-founder and the CEO of HAP Investment Partners. Dave Kusy, who is the managing director and partner at Gala Real Estate. Stephen Muller, who is the chief investment officer at Kuafu Properties. And last but not least, the statistician, I normally call him. His name is Robert Knakal. He's the chairman of the investment sales for Cushman and Wakefield. So where are people coming from?
All over the world, Michael. It's really been remarkable. I remember back in the mid-'80s.
When you were a kid?
When I was a kid in the mid-'80s, we saw a lot of high net worth individuals from around the globe coming into New York. And then it had kind of moderated for many, many decades. But for the last 2 or 3 years, we've seen more individual foreign investors coming into New York City than ever before. And it's truly been remarkable, literally from every corner of the globe, as these investors are searching for relative economic stability, relative political stability, and they're finding it here in the U.S. and particularly New York.
Where are your investors from?
Mostly from Israel, of course. But we have also a lot of investors coming from London now. Multinational people from London, German people from London. We have investors from Italy, investors from French, and we're starting to see now investors coming from Turkey.
And you?
Similar profile. A lot of Israeli institutions, investors. We've got some Chinese investors, Latin American.
Now,
European.
Are you a subsidiary of the insurance company?
We're not. No. Wholly separate entity, unrelated.
Does the insurance company ever invest with you?
We have multiple insurance companies that invest with us, primarily outside of New York, however. A lot of our New York-related deals are high net worths or other institutions. The Israeli institutions typically search for yield, and in New York today, that's less of a reality.
You know, we could say in New York, I think we can say in America, the yields are not that available. And your investors?
Our investors to date primarily come from China, mainland China. And they range from high net worth, ultra high net worth, to institutions, pension funds, endowments.
Why are investors from these places coming to America, and why, they look at, different New York City, and New York City is diverse. I mean, are they looking at places like Staten Island? Would they go to Long Island City? Would they go to parts of New Jersey that we discussed before? I mean, Jersey City is very hot, but Newark is not there. I noticed recently that, I think it was one article written, that a major Chinese investor went to Detroit. It's a different market. There's a great upside, but it's a higher risk reward.
I think that every investor case is different, no doubt. When I think about some of the regions that capital is coming from, specifically China and perhaps the Middle East, those regions have limited investable products at this time, and they're looking for diversity. They're looking to park money in different areas for portfolio diversity, political diversity, duration, timing. So there's a whole bunch of reasons.
Michael, the appetite, and I think, Steve, you bring up a good point, and the question was spot on. The appetite of this foreign capital today is more diversified than it has ever been from a geographical perspective.
But I think in addition to the appetite, I think the appetite on the assets are more diversified. Okay, at one time, I mean, for example, you came in 2009, your company. You've stayed predominantly in the multifamily arena in New York, and you've gone to other parts of the country, but multifamily. You came in about 4 or 5 years ago?
Yes,
Okay,
5 years ago.
5 years ago, and you, as opposed to established assets, okay, or transitional assets over there, you went in and you bought land, and then you started developing over there. Now
we started in New York. That's a great springboard for us. I think that the next steps are the New York tri-state area, and then from there, hopefully the Eastern Seaboard.
Now, but what you've also done, similar to Eran, is that you've gone into properties where you're planning to make developments.
Correct.
Okay, and you've gone to some wonderful sites, for example, 60th and Lexington Avenue, 86th Street and Lexington Avenue, where you're going to have both the availability of having retail below ground and residential on above ground. When people come to you, these investors, what kind of asset class are they looking at? We know that Folsom bought the Chase Manhattan Bank building. We know that Ang Bang bought the Waldorf Astoria. What are they looking at? What's the preferred asset? What are the different assets?
Yeah, Michael, there really is none. Obviously, foreign investors would love to buy a great located, cash-flowing asset.
And everybody in this room would want to buy the same
But-
asset, but you can't buy it.
But the fact is that in the 80s and 90s, foreign investors were looking primarily for cash-flowing properties. You rarely saw a foreign buyer look at a development site or a piece of land, as Eran's done with his company. And as we've seen lately, a significant percentage of development sites in the city now are being purchased by foreign investors. And most of that demand has focused on Manhattan. Certainly in past cycles it has, but in this cycle, we've seen that appetite spread out. 4 years ago, we sold a big site in Williamsburg at 421 Kent Avenue to Shin Real Estate. It was the first time a foreign developer had purchased a significant site outside of Manhattan. And we're seeing that trend continue. And we see foreign investors looking not only throughout all of Manhattan, but northern Manhattan, Brooklyn, Queens. It's really been remarkable what we've been seeing.
Are you being approached for joint ventures with other developers?
Less so developers, more so equity capital. That's what we've seen. And it's been over the course of the cycle, but certainly over the last 1 to 2 years, which I think coincides with the growth of Gaia, but also speaks to the availability and the flight of capital to the United States, to New York.
Now, when these investors come here, how much leverage are they looking on their deals, okay? Are they looking high leverage, or are they saying, I don't mind putting the money in here, I like the opportunities, and I'll be a lower leverage?
I think that answer varies depending on where the investor's coming from, the type of investor, and the type of deal. So in my experience, the investors that we work with are really also relying on us to use our knowledge of the local market and good business practice and sound judgment. And so we're probably not the highest levered developer out there. A great example actually is 60th Street. We acquired that asset with the next cycle in mind already when we saw that right away. And so we levered accordingly.
Most of our investors are looking for low leverage. They like the stable investment that the United States can offer. They like the stable investment that New York in particular can offer. And although they're doing development with us, which is a bit more riskier than income producing building, they are not looking to high leverage or too much risk.
Now, one of the big topics...
And again, I think like looking at the deal that you're doing for the next cycle without too much leverage, that's the right way investors, especially investors that coming from overseas, should look at it.
And there's also another situation, because if you over leverage at the beginning and you don't have enough money and the cycle takes a little longer, you're going to have another capital call that you're going to ask the investor to come up with. So that's the additional requirement. One of the big items which is in every day in the real estate rags and the websites is the subject of EB5s. And, last year there were about 9,300 EB5 acceptances. The majority came from China. I think there were 81% of that. Are some of your investors, and a number came from Israel, a limited number came from Europe, and so on, are any of your investors looking to also have the opportunity to get their visa? I mean, do you know about it? I mean, it's a question.
EB5 is a product that we offer, and I hesitate a little bit only in the sense that to date we haven't actually taken any EB5 money. Given our Chinese background, we think that would resonate well with EB5 investors.
Do you have a regional center?
Street, we do have a regional center. On our 86th Street deal, we are in the market looking for EB5 investors. I think that the local team at Kuafu, myself and the other executives, have a bit of I don't want to say mixed experiences with EB5, but EB5 I think generally is new for groups that have done it. They've done it. They understand it. For groups that haven't yet, it's still a process in understanding. The good news is the non-local team at Kuafu, right? They get it. They've done it many times, and it makes sense. The program's changing, and that has been a little bit frustrating, I think, to the market in general. And what the future holds for EB5 and some recent news, I don't know if the future is certain per se. But as far as we're concerned, it's another investment vehicle.
It comes up again in September. Last year, there were people who wanted to change it. Schumer is positive in it. It has certain pros and cons, but there are certain, as anyone would say, there may be certain bad apples in that market over there. But let's talk about, with regard to apples, you've stayed mostly residential.
We have.
With 1 or 2 office buildings over there. You've gone completely development. And you're really in development, but with the exception of Mima,
which is a conversion.
Which is a conversion.
And we're looking actually at some new conversions. I'd like to find more. I'd like to find rental deals. I'd like to find land that I can sell at lower price points to ordinary, normal human New Yorkers.
But that's the relationship with the question of, leaving the specific market. There is some land around, as I was alluding before. There's land in Staten Island. There's land in certain tertiary areas of Brooklyn. There's land in different, you could go to Long Island. You can look at Jersey and other markets. The investors who come to you from around the world, they don't know what Staten Island is. They don't know what Coney Island is. It was a big shock when people went to Jersey City a number of years ago because the world has changed.
So I can give as example our project in Jordan Square, which is a place that, of course, people from overseas definitely don't know. But you need to explain the fundamentals. So no matter which CEO came to see this project, we took him with the pet, in the train, not even a fancy car or something. We showed him how much time it takes from station to station. We did the whole thing with him, what you call with his foods, and you have to show the fundamentals. And if you show the fundamentals, real estate is real estate everywhere. And if you explain that there is good transportation, if you can explain the future of the area, if you can show the view to Manhattans, all of those things are fundamentals.
Yeah, Michael, ultimately, foreign investment is going to saturate into the outer boroughs in Jersey and surrounding areas, but overwhelmingly, foreign investors want Manhattan.
Yes.
And that has always been the case. It's a tougher sell to get them to look outside Manhattan, but increasingly, you are going to see that.
One asset class which I haven't seen that many foreign investors go after is luxury retail. Have you seen that? I mean,
they are interested in purchasing luxury retail,
but they haven't stepped up to the plate.
They have provided equity financing to local operators who really understand that market. The thing about retail is that it's so important and so dependent upon your ability to find a good credit tenant that will pay the right rent. And it seems like local market knowledge plays a bigger role in that space. But I think that you will see, you have seen and will continue to see equity financing for the local guys who buy a lot of that.
And in the same manner, I'll throw the other question. A number of developers and owners in New York have changed their mantra because there's not enough property. So what they've become is they've become lenders. Are we seeing, foreign investors becoming lenders?
Absolutely. Absolutely. That is certainly something that I think we're thinking about very actively, and I think it makes sense. The capital we're seeing from China understands lending. They understand how it works. Obviously, they may not understand the particulars here, but absolutely. And it's not just that the real estate markets have moved so that the local players have gotten into real estate lending. It's also the fact that the banks have changed how they're looking at the world in terms of lending. CMBS certainly is a materially different market. And so
senior loans are a different market.
There's a hole in the market.
Do you see yourself going into that perhaps one day?
We don't see ourselves. Now, perhaps in the secondary market, depending how life proceeds over the next 12 to 24 months, but we personally don't see originating loans. We're much more vertically integrated, focused on adding value to the individual asset, executing a business plan. So that's not our mantra.
Yeah, Michael, I think the changes to the FIRPTA laws haven't really kicked in yet.
Would you explain for my audience what the FIRPTA law, no inside baseball, I know.
Okay, FIRPTA is the Foreign Investment in Real Property Tax
which changed
Act,
the law changed.
which essentially means that when foreigners invest in real estate here, they are subject to a double taxation as opposed to buying stocks or bonds or companies or anything like that. So the modification to FIRPTA has for foreign pension funds has eliminated that double taxation. So I think you're going to see more foreign capital coming in, both in terms of equity to purchase properties. Those institutions will likely get involved in lending. And as Steve said, I think you're going to see a big appetite because the yields are a little better for debt than they are for acquiring fee positions in properties. And I think that'll become a bigger part of foreign investment as they get more comfortable with the various markets here.
Another area that foreign investors have basically shied away from is the hospitality business. Recently the Spanish chain Rule opened up on 46th Street. They opened up a a hotel, which they basically said in their press release, it took them about 6 years to find the property and another 6 years to negotiate and build the property. So it was a 12-year process. Now you're looking to do some hotel.
Right. We have one mixed-use project on the far west side, which includes a hotel in it. Keep in mind, though, we're really a local team. So in terms of local experience, we've done it before. I personally happen to like the hotel market. Generally speaking, I think with any acquisition you have to be careful, but it's an operating business, and you have to be in at the right basis. You have to have the right expense structure and the right target mix.
Since foreign investors and everyone reads the New York Times, The Real Deal, these other publications, and they hear that the condo market is down, and they hear that land prices have been reduced, how are they looking at, are they saying, do I want to stay on the sidelines until the prices really hit an adjustment? Yeah.
Absolutely not, Michael. I think a lot of the foreign investors have a very long-term perspective, and I've been shocked over the past 2 or 3 weeks. We're now in mid-April. Over the past 2 or 3 weeks, how many foreign investors have said, we want to be long condominium land in New York City, which is great. And we're very aggressively looking for sites for them now. But I was surprised to hear that they're very optimistic and very long-term in their perspective.
And what's your opinion of the condos?
I think to some extent it's a tale of two markets. You've got the high-end 2,500, 3,000 a foot plus stuff, which as we know has been sucking wind for the last year or so. The market we play in, the affordable luxury, let's call it $1,200 to $1,800 a foot, we've seen great absorption, great pricing. There has been a slowdown in the last few weeks. I would say it's probably too early to tell whether or not there's seasonality involved, but people see that, they understand that. Looking at land, how it's priced even today, the fact that you can underwrite those people, the new real New Yorkers, as you mentioned, that there's a real dearth of product and the availability to build or convert that product over the next 2 to 5 years, just by virtue of where we are.
And your type of property that you're developing, you have about 7 or 9 projects, right?
12.
12.
Investors still want to invest, especially in the area that we are working, which is mid to lower markets. But there is nothing out there. There is nothing to buy. There is nothing to invest in, like lands. At least lands, I don't see anything cheap or even reasonable. So I don't see any markets going down, or maybe in the luxury market. But we never been.
Please don't say that in front of.
No, we never been in that market, never ever. So even when we invested in different places in the world, we weren't in luxury markets. I don't really understand that market, but
I happen to agree. I think it's tough to find deals, and it's particularly tough if you're starting to hear noise in the market that perhaps there's overheating or maybe some developers will run into trouble. It's hard to justify making a very aggressive play, particularly when you have deals in a pipeline and et cetera. That said, acquisitions always has been a game where you can either buy through a broker, a marketed process, through a bid process, and acquire something quicker, or go the longer path and really put something together yourself, and one arguably gets a better value.
With regard to emerging neighborhoods, there's been a lot of development in Lower Manhattan, and there's a lot of development on the west side, the Hudson Yards and so on. We know you own some property over there, so it's specific. How about yourself? Have you looked over there?
We own a condo deal that we're selling out of 952 on 52nd between 9th and 10th. We love the area for a number of reasons. Proximity to Midtown, proximity to Hudson Yards, the inherently restrictive zoning,
Yes.
the preponderance of retail on 9th Ave and coming into 10th Ave. We also own a condo deal on the far east side, which we think has been overlooked as the market has increased. You're 10 to 15 minute walk from Grand Central. You're still in Midtown. There has been a little bit of a stigma over the past 10, 20 years, maybe more, with Murray Hill, but I think that has been an overlooked market. So right in our backyard in Manhattan is where we see some opportunity.
What about Harlem?
It's a great neighborhood, in my opinion. We have a lot of projects over there. I think it's a great neighborhood for rental. Maybe now without the 421A, it will be harder to do rental in those neighborhoods. But maybe there is a new opportunity for condo there.
Yeah, Michael, in the first quarter of 2016, land values are up almost 80% in Harlem. It's the only market that has shown a significant increase in land value.
But as I always say, there are three different Harlems. There's West Harlem, there's Central Harlem, and East Harlem. I think when you're saying the 80%, it may be total, but there's different neighborhoods and different restrictions.
It changes block to block and site to site.
100%
It's
over
more block to block than East Harlem, and West Harlem.
It's truly
I think
block.
it's more block to block.
There's enormous amount of development taking place in downtown Brooklyn and in Long Island City. As investors, what's your thoughts about those two markets?
Brooklyn is super hot. There's been a ton of development. There's going to be continue to have a ton of development. And I think that the demographic shift there is, I mean, you don't have to be a statistician to see that. Long Island City scares me a little bit. I just, this weekend took 59th Street Bridge, and you look out at all the activity and how much developable land is still there. I'm not sure that I personally would be running or advocating to run into Long Island City. But if I think about Brooklyn, it's hard to find values there too. So
The absorption Long Island City has been fantastic.
The absorption is fantastic, but when you have 9,000 units, it may take a little while to absorb the same situation over there. So, you know, to talk about this topic in 30 minutes is inappropriate. So hopefully later in the season or the new season, which will start in September, we'll all come back and discuss who's playing in the market and what everybody likes. I'd like to thank Eran, Dave, Steve, and of course Bob, and I'll see you next week.